good afternoon. You're tuned into closing trades on ET now, and for now the markets are looking a bit tepid. The market eluded that life high figure, at least as far as the Bank Nifty is concerned, 100 points away from that all-time high as far as Bank Nifty is concerned. Frontline indices are also marred by the ex-dividend adjustment going in for the HDFC twins. That's why you're seeing the underperformance at the frontline index level. Having said that, the broader markets are definitely outperforming today. So whether it's the mid-cap index or small-cap index, they are comfortably in the green. In fact, if you look at this, these indices which are away from the all-time high levels, it's Bank Nifty, which is just almost 100 points shy of that. But even the mid-cap index is not too far away. It's less than 1% away from its all-time high levels. Nifty, of course, has to travel quite a bit of distance, almost 500 points from the current, price at what the Nifty is trading at. But nonetheless, the Bank Nifty and the mid-cap index are close to that. FI buying has been continuing for 13 straight sessions. It's the longest streak that we have seen since August of last year. And today, of course, you have the public sector entities gaining in the trading session, the defense companies, etc. Autos have slipped from the highs. And then recently, we got good results from Bank of Baroda, IOCL as well as Kajaria Ceramics. So all of these counters are in focus, and numbers at the bottom of the screen were there for Max Healthcare as well. So we are tracking a lot of earnings as we speak, Aisha.
Oh, we are. In fact, as we speak right now, sources are indicating that IDC as well as Godfrey Phillips have actually undertaken price hikes. So you are seeing a little bit of ebb off come on ITC. I mean, given that cigarettes are the largest revenue pie for ITC, a price hike is bound to impact, at least sentimentally, their volumes. 3 to 5%, so that would be quite a bit of quantum. But let's see what size of the cigarette these price hikes have been undertaken on. That's ITC and Godfrey Phillips in trade for you, but that's okay. ITC is in any case around its 52-week highs, or all-time highs actually. But also good earnings coming in from Astral. We've seen as to how this stock has been on a tizzy, has been holding out very smartly from the word go. 6.5% higher on this one even right now. Skipper came out with good numbers, 6.25% move there as well. And Vesuvius India, not such a liquid counter, but locked in that 20% upper band as we speak right now. So these are a couple of earnings which are in focus. Of course, for Astral, the margins have expanded quite a fair bit, about 500 basis points. Skipper, the management spoke with us at ET now, indicating that they expect to double their revenues in about 3 years, and that FY24 margin guidance is at that 11 to 12% range. And Vesuvius as well has seen a blowout performance when it comes to their PAT, an uptick of 83.5%. Having said that, weak numbers for PVR have bogged down the stock from the word go. Of course, the content pipeline for Q4 wasn't all that robust. To add to that, you didn't even have many Hollywood releases too. So there's been a loss. The occupancy clearly has dipped, and they've also shut 50 of their screens. That said, Berger Paints, they've reported slower growth versus what Asian Paints actually delivered, but that's okay. It's not a complete apple-to-apple comparison, considering they cherish and stand on completely different market share levels. But the margins, yes, have disappointed for them. Dish TV, the minority investors have sought an AGM now to remove directors. Not such an actively tracked stock anymore. But let's bring on board Kunal as well as Naresh, find out what they are actively tracking right now. Kunal, largely consolidating, I guess, for the next dash forward.
Yeah, I think it's not an active market, Aisha. It's a very passive market because a 40-point range for the Bank Nifty, I think that's the highest end of the range which I've seen so far for the banking index. Very difficult.
Fell short of 10 paise yesterday. Anything is possible.
Fair enough. Again, no complaints for the market trend. We've had a very fabulous last 1.5 odd months, so maybe a couple of days of more consolidation. The only pattern which I'm spotting on many of the charts is that many of the pharma names, for example, many of the FMCG stocks, what they've gone through is after a steep rally, these stocks have gone through at least 8-10 days of consolidation before these stocks have managed to break out for themselves. So I would probably sense that this could be a similar pattern which could get repeated for the indices. So we are going into that patch of consolidation. I think we are almost on the 6th or the 7th day of consolidation. So maybe a couple of days of more consolidation before we can expect a bigger breakout on the indices.
Okay, so that's as far as Bank Nifty is concerned. But what's your take regarding the mid-cap, side of the market, Naresh? And which sectors of stock look the most interesting at this point of time? Naresh will have to unmute
The mid-caps, yeah. The mid caps and the small cap indices are outperforming today clearly. The Nifty is underperforming given the heavyweights. So we are down 50, 60 points on Nifty. The impact is 30, 40 points from HDFC Twins, another 20 points from Reliance. So overall, it's a very sideways market if you were to remove out the 2-3 heavy names. But the mid cap and the small cap indices continue to look very strong. Out here, we are seeing a lot of action on the NBFC space. So this is the new, say, leadership sector which is coming in place. So we've seen a breakout in Ujjivan. We are seeing a breakout in L&D Finance Holdings. We've seen this happen with the Mahindra and Mahindra Finance. Even the larger NBFC names like Bajaj Finance have outperformed. IDFC, one of the favorites, has been doing well. So NBFC and related financial companies are one which are coming on the radar. Apart from that, public sector enterprises continue to do well. Defense companies continue to make new swing and 52-week highs. So public sector enterprises and NBFCs seems to be the current flavor.
Okay, so that's the current flavor of the market, but there are a lot of stocks which are buzzing apart from news flow as well. So let's track some of that, also the price volume buzzers. First up, we also have names coming in with respect to Trident, wherein we have seen a breakout from the cup and handle chart pattern. It surpassed the 200-day moving average and has hit a 4-month high on an intraday basis. So Trident high by 6%. Birlasoft is seeing quite a bit of breakout today. It's hit a 5-month high on an intraday basis. The volumes are almost 5 times the 20-day average that we have seen on Birlasoft, and that's trending high by 8%. Mazagon Dock, apart from the other defense plays, is also quite excited. In fact, it snapped the 8th session streak of forming lower highs, and it's hit a 4-month high on an intraday basis. Volumes too on the higher side. Kunal, Trident, Birlasoft, Mazagon Dock, is there any name that you would like to buy even at the current level?
Trident could be interesting. The stock has confirmed the 200-day moving average breakout. That's also another technical factor which has happened today for Trident. Other than that, I think Birlasoft, I would believe that could probably be at the fag end of a price rally. So by that I mean, there could be at least a near-term correction for the stock, because the way the stock entered into the kind of a breakout from 260 levels to 300, consolidated for almost 8-10 days or at those levels, and then provided a breakout. So which means that the stock is entering into a bit of an overstretched zone for itself. I would sense that maybe the stock comes back towards 300, 310 odd mark. That could be a better level to buy. Trident could be interesting because price volume breakout, 200 moving average breakout, is a flag pattern breakout. All three of them have combined quite well for the stock, and we can expect possibly a dash towards the 40 to 45 zone for Trident.
Okay, those are a couple of active trades. In the meantime, let's also analyze earnings, and BOB came out with its numbers, a strong set at that. Let me take it across to Harsh and find out more on what actually led to this beat, Harsh.
Well, yes, Asha. So we're looking at net interest income largely in line with what the street was penciling in. 34% solid growth on a year-on-year basis, 7% sequentially. Margins continue to expand for Bob. We're also seeing OPEX though, which is quite elevated, in fact. So OPEX has come in slightly higher than what was penciled in. And operating profit therefore has come in slightly lower than what was really expected, 8,070 crore. That's also a solid 40% growth on a year-on-year basis, but provisioning was lower than penciled in, and credit costs have come in at just 14 basis points. So versus even when I'm looking at it sequentially, it was at 0.36%. So 37 bips to 14 bips, that's a sharp drop even sequentially off a low base. When I'm looking at PAT, very solid expansion, 168% up on a year-on-year basis, 24% up sequentially at around 4,770 crore is where that PAT number has come in at. In terms of growth though, things stand out. We're looking at advances growth of 18.5% on a year-on-year basis, 5% odd on a sequential basis, strong growth there. But the deposit number also standing out, 15% growth on the deposit front, 5% growth sequentially again. NPAs continue to improve, 10 bips on the net NPAs as well as gross NPAs improving around 75 bips. So across the board, it's a solid number, solid result. OPEX elevated but offset by lower provisions and credit costs.
Okay, so that's the take coming in on Bank of Baroda. It's a bit of a mixed set because OPEX cost is something that we'll have to watch out for. And remember, my colleague Ankur was also doing a story that perhaps the bank would be taking some provisioning for Go Air. So we'll wait by to get more details on that as well. In the meantime, taking stock of some of the other as well. Lemon Tree Hotels has seen a bit of a spike as we speak, and also Sonata Software has been trending higher. Safari Industries, though it was pretty sideways, the numbers look quite positive for Safari Industries, so let's watch out for that as well. How the stock is reacting, the numbers came just 20 minutes ago, and the brokerages are talking about that it's a solid set and it's a very good way to end the year as well. Naresh, your take on Lemon Tree Hotels, Safari Industries, Sonata Software?
So Lemon Tree is now coming back to the resistance of that price point it made around 105 odd 103 to 105 levels. So that's the target price for the near term. Still looks positive. The trend is still strong, and the whole hotel pack looks interesting. Sonata is the interesting one in terms of the fact how stocks have been very different in the IT pack. So Sonata Software has gone into a new all-time high, a fresh all-time high. Would be around dips back to 900, 920 levels. So clear-cut leadership we are seeing in the cap and the small cap IT names. Over the last 1.5 months, it's been mid-cap, small cap IT names which have done well, whether it's a Sonata Software or a Birlasoft or a KPIT. So clearly, this suggests that one should be looking at the mid-cap IT over the large-cap IT names.
Okay, those are some of the chats coming in or calls coming in on the mid-cap IT universe. The one stock that we want to bring up today is Oro Pharma, definitely. That sprung up quite nicely, about a 4.6% dash for a rank underperformer, if you could call it that, within the entire pharma pack, while Cipla, DRL, even Sun Pharma for that, to some degree, has held out well. Today, Oro Pharma is seeing a bit of a breakout as we speak. In the meantime, let's just take it across. We understand that Dish TV minority shareholders are actually looking at, they've requested an EGM and they're looking at, or rather seeking, a removal of 2 directors. So let's try and understand this a little bit more. We have with us Rahul Hingmire. He's the Dish TV minority shareholder spokesperson right now. Rahul, hi. Thank you for taking time out and speaking with us at ET Now. Tell us exactly what are the minority shareholders seeking? Why the ouster of these 2 directors?
Thank you. Thank you for having me. The shareholders of Dish TV, who are comprising of 10 to 15 equity shareholders, they have laid down their grievances in the notice very clearly, which is addressed to the management. The grievances are where the corporate governance by the management, by the board, has not been done as per the company's law and regulation. There are regular issues in which the necessary investment obligations or investment opportunities which the company has opted for have been flagged by the auditors as questionable investments. On various occasions, the board of the company has not adhered to required procedural laws, because of which necessary agendas which the company's board have been placing in last EGMs or AGMs, the majority shareholders have been rejecting them from that. If you can see last 5 to 6 AGMs or EGMs, many of the resolutions which board has proposed, majority of shareholders have rejected that. That itself shows the confidence in the board is no longer there from the shareholders, and these 10.15 shareholders have decided to take this issue in the right course of action, and that's why the requisition notice calling for EGM has been addressed to the board.
Rahul, just wanted to understand what's the timeline, if any, that has been discussed for this EGM, and the way things stands right now, do you believe you have the backing for now that you'll be able to remove these directors as well?
Our notice gives very clear reasoning as to why the change in the 2 independent directors who are long-term serving directors is required for. The timeline which we expect the board to adhere as per the company's laws is within first 21 days from receiving the notice. They should hold the board meeting to discuss and deal with the requisition notice which we have issued, and within total 45 days within the receipt of the requisition, they should hold the AGM meeting. That is the timeline which is prescribed under Section 100 of Companies Act, which we expect the board will adhere to.
Okay, so that's the latest with respect to what you're expecting. But Rahul, just wanted to get a sense from you. Are there any other such requests as well from other minority shareholders, apart from the the board and a couple of directors that you want ousted from the company? Anything else which is a crying ask from the minority shareholders at this point of time?
I represent the 10.15% shareholders who have cumulatively 18 crore plus shares in the HDFC company. They have come together and they have given us this mandate to address and issue this notice on their behalf. As far as other requisitions are concerned, that record is not with me at this moment. The reasons for which we have requested the board to convey this meeting EGM is just an appropriate. It is that was very apt and self-explanatory in nature as to why the two directors to be removed, because despite their presence on the board, the company has not given the returns or the response in the financial performance is very poor from the company. And we believe the three directors which our shareholders have nominated, they hold necessary credentials with the expertise and the experience in their respective professional careers. I think that sort of management change is required to change the course of action and to see the Dish TV company moves in positive side in terms of giving better returns, better interest, and protecting interests of the shareholders.
Have any names in mind of, are you suggesting some names from the minority point of view of who can be the directors or who could take the managerial position in the company?
That part is yet to be discussed. That is something as a course of action after the board is reconstituted as per our requisition. Thereafter, the board members will go about addressing these issues or filling up the vacancies right now. At this moment, the brief which we hold is very limited to issue the notice that we have done and understand the response from Dish TV. So far, we are yet to receive a response. Post that, we can decide the course of action accordingly.
Thanks so much for helping us understand the latest with respect to this development. So for now, we understand that Dish TV minority shareholders have requested for a EGM. The date is not yet decided. They are awaiting the response from the board and then they will decide the future course of action. But for now, the stock is reacting negatively, a cut of around 3%. On that note, we'll slip into a very short break. Don't go anywhere. Lots to discuss when we come back.
Back with closing trades right here in ET now. We're holding out just a little bit tempered. 18,382 is where we're currently at, 35 points lower. Torrent Pharma, Metropolis, PVR Inox, Steel, Berger Paints, these are your pressure points within the broader end of the market. Though it's interesting to note that the broader end of the market has managed to maintain its outperforming edge just by a little bit. You know, those hands are getting skewed, where it's still the advance is taking over, at least within the F&O universe. For the large caps, it's Bajaj Finance, which is the top mover on the index. There's ONGC, there's SBI and BPCL, which continue to hold out as well as we speak right now. But let's move on and let's welcome on board Sampath Reddy, CIO at Bajaj Allianz Life Insurance, joining in on the show right now to talk about where he's making the market to be right now. Sampath, hi, afternoon. Good to have you on ET now. Just wanted to understand how is it that you're mapping the market construct right now? Well, with 3 to 4 odd % away from an all-time high on the Nifty, but at the same time, just looking at the F&O positioning, looking at the under ownership within the HNI community, or for that matter, the fact that FIIs have just about returned to the market, gives you hope that there are more legs to go for this rally.
Actually, if you recall, markets have rallied quite well from the last 1.5 months from the lows. They're up almost like about 5 to 6%. I think large part of that is driven by, the softness in the interest rates. Inflation worries were there whole of last 1 year, 1.5 years, but now that seems to be behind. Inflation for the latest month has actually come below 5%. Interest rates in the last 1 month have also actually come down substantially today. The 10-year is just about 7 or even slightly below that. All of these factors are actually, adding, to the rally in the markets. And of course, coupled with that, FIs which were sellers, until few months back, until few weeks back, turned into the buyers. So all of that is also helping the market to, stage a strong recovery. And not only that, interest rate season for the quarter four seems to have ended quite well, and there wasn't many, disappointment, I would say. Some of the large sectors like banking has done exceptionally well, and today, the banking sector, which or lending sector, let's say for instance, account for almost about 35% of the market in terms of indices or in terms of the overall profit pool or profit pool of Nifty 50 companies, and that segment continues to do very well. Today, the large part of the thing which represents the Nifty 50, which is BFSI space, is in one of its best position in terms of, if you look at the NPAs of the banking sector per se, they are multi-year lows, and the net interest margin, if you see, they're also at multi-year high. Large part of the corporate NPAs which were totally behind us now, and bulk of the growth for the credit is coming from the retail where the asset qualities are much better. So overall, I think markets are positioned quite, and we have been of the opinion that somewhere during the middle of this calendar year we could see a strong recovery in the overall equity markets. That is largely because the interest rate hiking cycle would have been very much behind, which now it looks like interest rate cycle is close, certainly interest rate hiking cycle is certainly behind. So based on that, we continue to believe that middle of this year, calendar year, we'll see a strong recovery in the equity market. I think we are already in that midst of recovery in the equity market, I would.
Expecting a bit of a recovery in the second half of the year, or at least in the next few months. Sampath, we'll try and reconnect because the line seems to be a bit patchy. But in the meantime, let's go across to my colleague Shara to try and understand whether the retail participation in the market is high or not, because it looks like that the demat account opening, etc., has been petering a bit, and the overall, participation from retail investors has also ebbed a bit. Shara, tell us what's the data pointing.
Well, yes, demat accounts, new opening has actually come down for the third straight month, and do remember this is coming at a 9-month low. Now, apart from this, also do remember that it's down almost 16% on a month-on-month basis and a 25% degrowth when it comes to the new account additions via the demats. Now, if you look at the FY23 average demat numbers, that comes at a monthly pace of almost 21 lakhs, and currently sitting at the month of April itself, the number has fallen to 16 lakh. So that is something which is important. And apart from this, do remember CDSL has actually gained their market share, but there are certain reasons also why the impact is happening on the slower demat account additions. This includes job sentiment, which is coming in mixed, with of course IT hiring freeze are happening across the sector, cost cutting measures in the startups as well we are seeing, and also the volatility in the markets over the last 2 to 3 months, which has actually impacted the demat account additions. And we can see over there in the screen itself the incremental demat accounts that has been following, and we see over here in the screen that the entire total demat accounts has also actually gone gradually up to almost 11.6 crore accounts totally. Apart from the demat accounts, another important data point we have got is the active user client base, and that has fallen consistently for the 10th straight month as per the data by NSE. And lastly, the SIP numbers is something which I'd like to point out, that is coming in at almost 2-month low, and do remember it has fallen almost 4% on a month-on-month basis.
Those were the key internals. Sampath, your take on some of those factors that my colleague was pointing out to, the fact that the SIPs have slowed a bit, the demat addition has been lower, and even the mutual funds are sitting at higher cash levels than earlier. What's your take of how the retail participation is actually expected to trend going forward?
Yeah, I think, domestic participation has been quite good in the last couple of years, and especially the number of, the new investors in the market has grown tremendously. In terms of whether the number of new demat accounts or etc., all of that has done exceptionally well in the last 2 years. Of course, from the peak, the rate of growth may not be that high, because given that there has been a substantial growth in the last 2 years. But if you look at the flows into the domestic institutional investor, whether it's mutual fund or insurance companies, they continues to be quite good. Last few years, domestic institutional investors, including HNI and retail, have been a big supporter of the Indian equity markets, in spite of there were some outflows from the FI side. We continue to believe that equities offer an extremely attractive proposition for domestic investors. I think there will be a small periods here and there, temporarily based on the valuation, based on the certain events. There could be a small outflows here and there, but in the longer term, I think domestic liquidity will continue to be quite strong for the equity markets as such.
Sampath, good to have you on the show. Unfortunately, we'll have to let you go. We're having a bit of a trouble with the order line there. We will see you again soon. Let's take stock of what the market is up to. Dipped a little bit more, 63 points lower right now. So let's get in some closing trades going. Kunal, what's on your list?
So I'll suggest a couple of buy calls, expecting this, the stock-specific approach to be a bit more better. Sanghi Industries is the stock which I would suggest as a buy on the short-term basis as a BTST play. Targets of 85, stop loss to be kept at 70. And the second stock which I would initiate would be a Contraband IEX. The stock has recovered almost a V-shaped recovery on the intraday charts. Targets of 168, stop loss 157.
Right. Naresh, your closing trades?
So that would be a buy on L&T Finance Holdings. The stock is given a breakout about that 95, 98 marks, has tried crossing 100 today as well. Short-term breakout done, a long-term breakout also in the making of the last 2 years. Over a period of next couple of months, I would have a target price of 125 here.
Okay, so that's the closing trade that Naresh has for us, L&T Finance. But in the meantime, let's take stock of some of the other movers as well. Sonata Software, we were just speaking about that stock, and it's moved high by 8% now. And that's not it. Some of the other mid-cap names are also doing quite well. Birlasoft, for instance, is high by around 7%. You also have Cyient, which has been doing well. So a lot of these names which are buzzing in the trading session. On the losing side, however, it's Zensar Tech after that solid run-up of around 20-25%. That's seeing some profit booking today, down 7.6%. And Jubilant Ingrevia is reacting to a weak set of numbers. That stock is seeing a dropping of almost 5%. That's Jubilant Ingrevia for you. The solid cut coming in after the results as well. With that, slipping into a very short break. Welcome back. For now, the market is just around that 18,300 mark. A bit of a dip is what we have seen in the last few minutes. 0.5% cut, 100-point dip coming in for the Nifty. Let's pull up the Bank Nifty as well and see what's happening there, because at least at the start of the trading session, it was supposed to be the ex-dividend performance of HDFC Twins, which was weighing on the market. But in the last few minutes, it is perhaps the IT sector as well as the other heavyweights which is putting the pressure on the markets, because today auto index is also on the back foot. That one was sitting at live fire levels earlier, but today we are seeing a bit of a slip there. Media, of course, is on the back foot, led by Dish TV. PVR Inox is also not helping that case. And then Bank Nifty also has now moved into the red, a cut of almost 0.25% coming in there. FMCG Metal, a lot of these names have actually turned for the worse. Kunal, what do you think is the pressure point for the markets at this point of time? Is there a space which is looking very weak? Because IT is something we have been talking about, could be a contra buy. What's then pressurizing the market, you believe?
So very weak, I'm not sure very weak, but IT is an underperformer.
Okay.
But most of the other sectors and stocks have actually outperformed. Now, the only reason why I would believe that the markets can, I would not say correct, but consolidate, is there's a lack of large cap names which are looking very formidable in this leg. So earlier, for example, there was L&T, Bajaj Auto, ICICI Bank, HDFC Bank, which led the markets higher by the 1,000-point recovery from 16,800 levels. But now from current levels, because the move seems to be exhausted into most of the other performing large cap names, that's why you're seeing the indices struggling a bit. So I believe that till the time we don't see any fresh set of large cap names participate, I think it's going to be difficult for the indices to get into an immediate breakout. And that's where I believe that traders could try and take opportunity of this consolidation to try and focus more on mid caps and small caps, because you look at the slew of stocks and the volume patterns for many of the stocks. There is huge amount of volume which is skewed towards the mid cap end of the market, not clearly seen towards the large cap end of the market. And I think that's where the indices may get into a consolidation. The action would be more specific towards the momentum names. So buying momentum stocks could actually be a better strategy in this kind of a market. Not expecting any major sector to get into a correction, but the usuals, the likes of auto, for example, could get into a mild correction, maybe a couple of percentage points further from current levels, but nothing major as such.
Right. Although for the Nifty, we've taken a sudden dip now. We're down about 0.5%, so pretty much around the lowest point in the day. But Devin Choksi as well joins in on the show right now. Devin, hi, afternoon. We've just been talking about as to how indicators, or rather all indicators, seem to be hinting at more legs for the markets from here. Be it the FI positioning, the comeback they've made, the cash levels that mutual funds are sitting on, the under ownership from the HNI fraternity, all seems to be indicating that there's more green to go.
Yes, Aisha, good afternoon. Of course, I think the fundamentals of the economy and fundamentals of the corporate sector have actually resulted in changing the mood of the investors and the stakeholders in the market. And that is definitely helping the market to come back. And also, fortunately, I think the selling portion has stopped from the global traders, which has probably allowed the market to stabilize. Having seen this journey, I believe that 23-24 remains even more positive than what was earlier envisaged for two reasons. One, importantly, the crude oil prices have cooled down and they are promising to remain at a lower levels. Should that be the situation continuing, then the commodity prices, food commodity and the metal commodity prices, they would also remain under check, and that will probably help most of the companies maintain their margins, which were up till now, I think, affected in the last financial year in some of the quarters. Now, these points are definitely helping the companies to grow with confidence in coming period, because on one side, due to the strong demand situation that we are seeing in the economy, which is continuing due to infrastructure by the government, and also because of the industry's expansion. And on the other side, if the input cost remains under check, the profit margins remain better, so the profits and the profitability. So all in all put together, this is inviting, I think, more attention, and as a result of which higher confidence leads to a better infusion of funds, and that's the steady movement of the market. Maybe today's market is somewhat corrective, having touched the higher levels. I would think that I think with this correction, probably you would see more entry of investors into the market.
Definitely giving more opportunity for market participants to enter, because it slipped below the mark of 18,300 as well at the lowest point of the trading session as we speak, Devin. But Devin, wanted to talk to you about the entire defense pack as well. The likes of Mazagon Dock, Garden Reach, Cochin Shipyard, etc. These are all buzzing in the trading session today. Though it's a long gestation story, would you be a buyer in these names despite the run-up we have seen on a YTD basis?
Yes, I think the run-up is little ahead of time, but that's the character of the market, that's the nature of the market. Market always runs little ahead of time. In my viewpoint, I think many of these defense companies with a strong order book position definitely suggest that they've got better visibility of generating revenue and profits than before. However, the fact that I think defense companies along with railway companies, they normally operate at a tight margin, at a very, very competitive margin. And given that kind of a situation, many of these companies would definitely, I think, produce higher revenue and the profits, but on a smaller or comparatively competitive margin. They don't have enough amount of what is called downside protection or a margin of safety, as you call it, as long as I think the making a mistake is concerned on the margin side. Should that happen, then probably the current valuations may not sustain, and that is the only caveat that one can add at this point of time. Having said that, any corrective downside in the market, which we saw typically in the February and March month, such kind of corrective downside in the market whenever it comes, and I think at that point of time, defense and railway stocks could be once again re-entered into by the investors. If they found it, I think, little expensive at this point of time, I think the opportunity should be to buy at lows during such corrections.
Sure. But Devin, it's a large list of defense as well as railway stocks out there, right? Could you narrow it down perhaps to the two best picks from each?
So I think we have been liking companies like Solar Industries, I think, which has been a relatively a steady performer with probably, I think, no competition as far as I think their product range is concerned. So that is one company which we have continued to like all along all these times. In the other segment of defense, I think probably one of the newer entrant in the market, it appears a little bit more promising, which is a company called DCX Systems. Which I think relatively more promising company, though I think their accounting is highly skewed for the last quarter vis-a-vis I think the first three quarters. I think that's where probably one would not get the consistency of the quarterly results. But otherwise, I think the company looks relatively more I think promising at this point of time to add into the portfolio. Similarly, the situation could be for the railway stock. I think many of the companies where probably I think you would have higher opportunities, particularly the likes of BML, they remain relatively more safer as far as I think the outlook goes from the business perspective.
Devin, you have been quite positive about the mid-cap IT space, right? Whether LTTS, LTI, Mindtree, Sand, etc. Have you been nibbling into any more mid-cap IT names?
No, I think the time to remain selectively confident about, I think, these names, LTTS, LTI, Mindtree, Science Technology, Tata Alexi, I think is definitely there, because I think more importantly in these companies, on one side, I think they are catering to a very niche segment. In respective companies are catering to a very niche segment. Some of these companies are also catering to the engineering side of the IT business, and that is probably, I think, more stronger, because I think that is a specialization which the normal IT companies would not probably possess. And as a result of which, I think they have two solid unique selling proposition that they have. On one side, the customers are fully dependent on them, and they would not easily move around because of, I think, this kind of domain understanding on the subject that this company brings for their customers. Other side, I think the margins are protected relatively much more than I think the normal IT companies would face a problem with their clients. So I think this niche player, they remain relatively more stronger play in the IT pack, though some of them may be quoting relatively at a higher valuation currently. But given the chance in the situation when the correction takes place, probably I think they would remain a buy opportunity, because they continue to grow at 25 to 30% rate of growth. At least in next 3 to 5 years, that visibility is continuing in some of these names.
Just looking at the, realty pack as well, let's revisit those considering they were the biggest movers yesterday. What with the move coming in on DLF after recording its FY23 pre-sales, which was clocked at a record high, and more importantly, them giving a pre-sales guidance of 11,000 to 12,000 crore rupees for the fiscal. Also, 11 million square feet in FY24 worth about 19,700 crore rupees is what they're looking to launch. And that really got the entire street exciting. But before we talk about that, let me take it across to Somit, find out what to expect from Airtel's numbers. Somit?
Well, for Airtel on a consolidated basis, if we see, it is expected to be a muted set of numbers. Revenue and EBITDA is expected to be higher by around 2.5%, while the margins are expected to come in flat at 51.4%. But it is the India mobile business number that is the key number to watch out for from Bharti Airtel earnings, and that segment's revenue is expected to be higher by only 1.5%, which is the lowest in the last 10 quarters. And this is because of an absence of a broad-based tariff hike that the company did not take in the fourth quarter of FY23. Now, the EBITDA growth for the mobile business is expected to be around 2%, and this is largely on account of marginally higher ARPU and subscriber base. The growth we are seeing on the ARPU front is largely owing to the hike in minimum recharge plans, which was done by the company in a staggered manner throughout the fourth quarter of FY23. Now, subscriber base is expected to be marginally higher, but there are some analysts who are also expecting the subscriber base to come down for Bharti Airtel in the fourth quarter, so keep an eye out for that number. Now, apart from the mobile business, if you see the broadband and enterprise business revenue traction is expected to be robust, while the DTH business segment is expected to report a sequentially weak set of numbers in the fourth quarter. Now, apart from the earnings, the key things to watch out for would be the management commentary on timing of tariff hike, because that is a key thing for earnings growth when it comes to Bharti Airtel. Apart from that, 5G subscriber base, what are the new trends that they're seeing in 5G additions, along with this, the capital expenditure plans, and how they're seeing the broadband growth going forward would be important to track from Bharti Airtel earnings.
Okay, we'll track all of that. Thanks, Amit, for joining us. But sharp dip as far as market is concerned. Nifty is now 115 points lower. The bank Nifty slipped as much as 200 points below the mark of 43,900 as far as bank Nifty goes. Naresh, your take, what do you make of the turn that we are seeing in the markets at this point of time, and should one buy the dip now?
So looking at this as a buy zone, getting into that to 43,800, 43,700 mark on the bank Nifty would be a retest of the short-term breakout. So that's a point one should be looking to buy. Same is the case with Nifty, closer to 18,200, 250 would be a buying zone. Overall, the view remains positive. What we've seen today is a little bit of a correction in the heavyweight names. So we are seeing a cut on HDFC Twins due to the dividend. Plus, you're seeing a little cut on Reliance Industries as well. So it's more a heavyweight based correction today. The breadth is still pretty strong. So overall, taking this dip as a buying opportunity, at least in the bank Nifty.
We just, highlighted what we expect from Bharti, but Jubilant Foodwork is also going to be reporting its numbers. And given that Sapphire Foods has actually seen a slower same-store sales growth, all eyes now are on Jubilant. In fact, Vinny is here to tell us what the street is anticipating.
So in terms of numbers from Jubilant Foodwork, we are expecting a 9%, 8 to 9% growth in terms of the revenues coming in from the company. While obviously on the operational front, we are expecting pressure coming in over there. Profits are expected to see a decline of 45%, while the EBITDA is also expected to see a decline of 11%, and the margins, a sharp contraction, is what we are expecting of around 460 basis point contraction in terms of the EBITDA margins of the company. Now, like for like growth, which the company gives us, we're expecting a flat growth over there, nothing exciting, muted growth on that front. While obviously the revenue growth is also just at 9%. Why? Because there's a demand softness that we're seeing, and that demand softness maybe could have impacted even Jubilant Foodworks, and that's why only a 9% growth in terms of the revenues of the company. Gross margins, so we're expecting a decline even and a contraction on a quarter-on-quarter basis as well, so sequentially also, and similarly obviously that comes down to the EBITDA margins as well. Mainly the factors that are impacting the margins of the company and contraction even on a quarter-on-quarter basis is inflation that we are seeing, prolonged commodity inflation, as well as a bit of a negative operating leverage, which could impact the margins of the company. Factors and commentary that we'll be watching out for like growth, what is that coming in at, what is the commentary on that for going forward, demand trends across channels as well as across cities and tier 2 tier 3 cities as well, store expansion plans for the company in FY24, how is Popeyes performing, what is the expansion plan going forward there as well, are something that we're watching out for.
We'll watch out for all of that. But Kunal, your take on Reliance Industries as well as ITC, because these two heavyweights are putting pressure on the markets, apart from, of course, the HDFC twins.
Yeah, ITC could be a good profit booking, stock at current levels, because the stock was overheated. 430.35 was the level for ITC, where the stock had seen a bit of resistance. Yesterday was a day where the stock had actually rallied, but today is a day where the stock is trying to compensate and come back towards the mean point. My sense is that the stock should come back towards at least 410, 405 in this leg of correction. That could be a good zone to buy back ITC or look to buy on dips. Reliance could be tricky because the stock in the last 1 or 2 weeks was just about going very sideways. It was stagnating at the 2,500 mark. I think 2485, 2490 was the previous swing high for Reliance Industries, and the stock was just stagnating at those levels. So we'll wait out for a breakout back again about 2,500 for momentum to come back again. The only concern with Reliance Industries as a chart is that when you typically tend to buy on dips and look out for these kind of opportunities to go long, the stock stagnates for a lot of time before it gets into a breakout mode. So it's always better to participate on the breakout because the time span reduces significantly and the momentum tends to kickstart quite smoothly at those zones.
Devin, your take on Reliance and ITC?
I believe that I think these companies are basically ready for a higher amount of growth in their business. In case of Jio, the 5G rollout, I think by the end of this year, is expected to generate significantly high amount of revenue for the company eventually, because one after another format which they are contracting, I think they are basically generating significantly high amount of data consumption and also the customer base. For example, the IPL season, till the last we saw, I think they ended up seeing about more than 1300 crore videos, I think, downloaded. Now, given that kind of a situation, when the company ends up charging them even for the micro usage, I think for the videos, I think this could possibly mean that a significant amount of additional revenue coming into the books of the company through just one incidence or one activity like IPL. Similar such kind of activity could possibly generate significantly high amount of revenue and the profits, and then the catalyst would be 5G, as I see. So Geo platform is definitely, I think, a key driver. Another key driver remains, I think, the retail, which is the omni-channel platform that they have with higher number of store on the ground, and I think the digital connectivity to the end customer. So that also remains strong proposition. And both these verticals are expected to eventually unlock the value for investors by way of separate listing, which Geo Financial Services is currently doing. So all in all put together, I think the Reliance remains favorite pick because of the strong fundamental subject, I think, which they are probably following. Along with that, I think in a couple of years from now, we are also going to see the complete ecosystem of renewables getting rolled out. So that will also be, I think, value accretive. Similarly, the situation with ITC, On one side, I think each of the verticals are making profits for them, including the FMCs and the hospitality business and the agribusiness, software business verticals. Everywhere, I think the company is seeing the largest scale happening for them. Given that situation, any correction in the prices of the stock would definitely mean a welcome buy for many of the investors who have missed out this opportunity. I think that next 2 to 3 years from now, this company looks, I think, reasonably on a strong wicket for generating higher amount of return for investors.
Kunal, how much do you think could be the softness on ITC, and then what becomes a buy level?
So, the earlier support for ITC where it bounced back, I think 2 days or 3 days back, was around 416 mark. And then the bounce for ITC is still 430 levels, which means that we can expect the stock to, fall back at least 10 to 15 points further from the 416 breakdown point, which gets, the stock back towards 405, 410 mark. I'll also look at it this way that ITC has been one of the few stocks which tends to get a lot of attraction from option writers and specifically at the round figure mark. So whether it's 400, 450 strikes, these are very strong strikes for ITC, and typically we've seen that closer to 400 mark there is huge amount of put writing which tends to act as a support, and maybe closer to 450 levels the stock finds a lot of call writers. So I think that's also one of the reasons why I would believe that maybe in this leg the stock may not fall significantly below the 400 mark. 405, 410 could be a good support zone. If the stock or the selling stabilizes at those levels, that could be attractive buy point for ITC.
Okay, so that's a deep dive into ITC as well as Reliance Industries at this point of time. But in terms of other movers, you have Yes Bank, which is seeing a bit of attraction. We usually don't talk about this stock, but just volume seems to be on the higher side today. CAT is one stock which is also seeing quite a bit of traction as well. And then, of course, Trident, Birlasoft, these are some of the other names that have been coming on the radar. Devin, your take about this entire urban consumption theme, and I'm talking about the QSR space, PVR for instance, and even the hotel stocks. Which are your favorites in this particular vertical?
Space, definitely, I think all these companies would have relatively higher business to talk about, no doubt about it. However, I think the valuation wise, most of them have ran little ahead of their actual profits that they would be producing in financial year 23-24. So frankly, at this point of time in our portfolios, we have no selection probably from this particular list of stocks. So we continue to like the underlying strength of companies like Indian Hotel for that matter. And I think, but we are not putting in a higher amount of money at this juncture, largely because of the fact that we believe that they have ran ahead of time little bit, and any correction in the price would mean a meaningful downside protection for us to add into the portfolio.
Okay, that's the take coming in on Indian hotels. In the meantime, let's just take stock of what Jubilant Foodworks is up to. We just told you what to expect from the numbers, and then where Sapphire Foods is actually settled in at, considering they actually saw a dip when it came to their same-store sales growth. Sapphire Foods, although it started off weak, has recovered just a little bit from there, about 1% higher. It's important to see also what the global construct is, because Europe, as I see on my screens, is just marginally in the green, largely flat, you'd have to say. The DAX, the FTSE, or for that matter, the FTSE MIB are just about marginally in the green. I would call it flat. And the pre-market rates for the US futures as well are indicating a very, very tempered move. Although Janet Yellen has once again set out the warning that US could default on its debt ceiling come June 1st, but that doesn't seem to be spooking the markets just yet. For our markets though, the weakness continues. We are now at the session lows as we speak. 18,361 on the futures, a downtick 18,314, I stand corrected, a downtick of 100 points is what you're now staring at for the Nifty. M&M Tata Motors, they're actually a top drags. And they've been, I guess after Tata Motors' excellent performance and the way the stock has appreciated, I guess this also falls in the same category as ITC, wherein you are seeing some profits being taken off the table.
It's natural, I think. I think some amount of profit booking by the traders is definitely natural, because I think the stock has had a good rally in the last couple of months, particularly post-March. I think this both Tata Motors particularly and the DVR, I think both of them have actually appreciated may around 15% or so. So from that perspective, I guess I think it is natural to see some profit booking, but the fundamentals of this company remains, I think, absolutely very, very strong and convincing. On one side, the passenger vehicle portfolio is driven largely by the EVs, and that is where probably higher demand and traction is being seen. So visibility of the business continues very, very strong in passenger vehicle. JLR portfolio, which up till now was a trouble portfolio because of variety of factors. Probably I think that is also trying to come back into a good shape. Also the fact that I think the electric vehicle portfolio in JLR from 2025 onwards could possibly promise higher amount of demand for them continuing in subsequent period. And commercial vehicle, which according to me is I think the strongest of the lot as far as I think their business is concerned, because of the fact that higher demand is getting generated on commercial vehicle side due to scrappage policy, which is getting into force now. And at the same time, higher amount of demand coming in also because of the fact that I think infrastructure spending in the economy is increasing. The fact that I think higher amount of industrial activity is happening in the economy, creating better higher demand for commercial vehicles. So I remain particularly very strong on Tata Motors. Maybe correction would lead to some kind of a price moderation, but that would be an opportunity for investors who have missed out the rally.
Okay, so that's the take coming in on Tata Motors and some of the other auto names as well. In the meantime, Naresh, your take as far as some of these NBFCs is concerned, especially the, the mid ones, the likes of LIC Housing Finance, even Manappuram for that matter has been fairly volatile, Bajaj Finance as well. Are there any names that you would like to cherry pick from this space?
So out of these names, the ones which have clearly given breakouts are Mahindra and Mahindra Financials, which has done well over the last couple of months. Second, we are looking at L&T Finance Holdings, which is breaking out. That's another stock which is a fresh breakout that looks the most promising at current levels. And then you have IDFC Limited, which has already done well. That still looks interesting on dips. So these are the three names which are clearly showing leadership. Then on the other side, there is something like Ujjivan Finance, Ujjivan Small Finance Bank, Equitas. These are the names, and watching out for the smaller names like Spandana, Satin, etc. So overall, the whole NBFC space looks interesting, but as of now, L&T Finance Holding remains top bet at current levels.
Right. A couple of other active buzzers in trade, while of course a lot of the market is actually seeing a cool off, Tata Motors, M&M, Maruti. So you're seeing a big drag down for autos, which are a rank underperformer, but Bharti ahead of its numbers also is down to 788 levels. Reliance also is down 1.5%. Kotak Bank, L&T, ITC of course is seeing a crack amidst agency scoring sources that both ITC as well as Godfrey Phillips are going to be undertaking a price hike of about 3 to 5%, not across the board in certain specific cigarette categories, albeit. There's also HDFC Bank, but that's an dividend play, which is why that's that adjusted price. There's also ICICI Bank, which continues to lie flat, so it's not really falling. It did not even move up yesterday. TCS is absolutely flat. DRL has given up its gains. Axis Bank is lying flat now. Divi's has cooled off. So has IndusInd Bank. It's only Coal India, ONGC and Bajaj Finance which are largely sticking on with their gains. Even SBI and Infi have eased off from where they were just a short while back. But Devin, we were earlier highlighting about realty and the precedent set by DLF in terms of the guidance that they have set out. How does it spell for some of the regional and smaller realty players, you think?
So more importantly, I think the amount of development that they are having in their hand, or the stock that they are having in their hand, is suggesting higher amount of visibility. In most of the cases, I think we are seeing the level of stock has come down, and particularly in segment, I think the buying demand remains absolutely convincing, along with the low cost housing. In the premium segment of housing, I think the recessionary impact or the high cost of interest rate impact has also not been seen. So all in all together, if you look at, I think all the three space, I think the affordable housing, the mid segment of housing, and at the same time premium housing, in each of them, I think the demand scenario remains absolutely convincing. With higher amount of demand, and the conviction remains in tier 2, tier 3 cities where you are having the mid-tier portfolio, which is basically asking for higher amount of sales for most of the companies. I believe that I think that journey continues for many of them. And fortunately, because of the reduced pressure on the input cost, is also suggesting that most of these companies would end up reporting relatively more stable margins, which are more predictable at this point of time than before. So that could possibly argue in favor of some of the real companies. But those who do not want to play the quarterly fluctuation into the real estate companies, because they take time to deliver the projects, and at times everything won't get reflected into the quarterly results. For them, I think the safer bet, in my viewpoint, would be the housing finance companies, because housing finance as a portfolio is growing at a pace of around 20% on a cumulative basis. And that is possibly giving relatively higher amount of stability to long-term investors who can easily compound their wealth around this level if they buy into this particular space. So I would prefer to be on a safer side, playing
Right.
with housing finance portfolio.
Sure. Okay, so that's the take coming in. On that note, we let you go, Devane. But for the market closing, ending close to the lowest point of the trading session, below the mark of 18,300, the advanced decline ratio was also tilting towards the decline by the end of the trading session, and the Sensex 2 dipping below the mark of 62,000. We are waiting for the all-time high levels on Bank Nifty. That has actually become much further than where we were yesterday, because the Bank Nifty also saw a decline of almost 200 points in the trading session today. Of course, it was the HDFC twins which were going ex-dividend today, but separately Tata Motors, M&M, Kotak Mahindra Bank, Apollo Hospitals, these were your top drags at the index level. You also had names like ITC as well as Reliance Industries. These two were putting pressure on the markets. On the gaining side, it was the public sector entities, so BPCL, Coal India, ONGC. These were the stocks which were excited in the trading session today, but just around that lowest point of the trading session is where we have shut shop, Aisha.
Yes, and on that note, we're going to wind it up right here on this edition of Closing Trades. We'll see you with the market action tomorrow morning at 8 a.m.